Hi everyone. Today we're just going to talk about the past month's economic events and how they relate to the property market in specific. I think the highlight or perhaps low light of the month was a further interest last month was a further interest rate hike of 75 basis points, and that came on the back of the most recent CPI inflation figure surging upwards still higher to 7.4%, largely driven by petrol price hikes of recent months. But also there's a food price inflation surge. There's been Ukraine output issues and global food prices surged not so long ago. And so there's still a significant food price impact coming through as well. So higher inflation, higher interest rates, and to date the Reserve Bank has now hiked interest rates by 200 basis points since late last year. That starts to make a difference to a credit-driven market such as the property market, I believe. Now, you may then look at a more recent development, which provides some encouragement. Early this month, we saw the first fuel price decline announced. But I would probably not get too excited just yet. If you look at the Gauteng pump price, it's still near to 25 Rand. So fuel prices are still very high. But also, I think that the negative impacts or the dampening impacts on the property markets still have to feed through in their entirety from inflation and interest rates that have been rising and an expectation that interest rates still have further to go. So I don't think the cooling effect on the market is done yet. And I believe that in the second half of this, or the half that we're in now, we will see further dampening in sales activity in all three commercial property sectors. Now, what did we see in the second quarter according to the FNB Property Broker Survey? Well, we saw sales activity ratings in both the retail property sector as well as the office property sector start to decline after prior months of improvement. We didn't see that yet for the industrial property sector, but I think that now with not only South African interest rates rising, but global interest rates rising, the global economy slowing, I do believe that probably all three commercial property sectors might see some dampening in demand, in the buyer demand or investor demand in their markets. That's what still has to come. The CPI inflation rate is probably not done yet. We anticipate that it will probably peak nearer to 8% late in this year. You have to allow for a certain amount of second round effects in the inflation numbers. First round effects come as there is a direct petrol price surge, for instance, or food price surge, and then the pass on as producers pass it on in the end to the consumers. So there's a second round impact as it goes through the whole supply chain down to finally the end user of the product. So those second round effects still have to feed through, and it's possible too that inflation expectations may go higher still in response to recent inflation numbers, and then that becomes a bit of a self-fulfilling prophecy as well. So inflation, the inflation rise we don't believe is done quite yet, and as a result we also don't believe that the interest rate hiking is done quite yet. And prime rate, which is now at 9%, we believe could peak at above 10%, 10.25% early next year before it stabilizes. So there's still some rate hiking in the pipeline, we do believe. So it's still on the negative side or on the cooling side, we believe overall for property. There's still the impacts on the economy coming through. We saw the manufacturing PMI, Purchasing Managers Index for last month just released a few days ago, and that dipped to below 50, so it sort of pointed to contraction in the manufacturing sector. So the economic numbers are not wonderful just yet, and that has a direct impact, we believe, on property and property demand. So slowing is still the order of the day. I believe that the further interest rate hiking keeps the pressure on property values, keeps capitalization rates drifting upwards as they have been doing for a few years now, and will keep real values declining. Now, when I talk about real values, I'm talking about maybe not nominal value, actual values declining. They might have some very small price growth, but not keeping up with general inflation. And when that happens in real terms, as us economists talk about, you are correcting. We've been correcting since about 2016, and the All Property Index of the MSCI by last year had corrected downwards by about 25% in real terms when adjusted for inflation. And I do believe that the economic environment and the interest rate environment that we're currently in sustains that real value correction in the commercial property market. I still think that the industrial property of the three commercial property markets will remain the outperformer, although possibly also coming under some mild pressure from interest rates hiking and inflation. But it's got more going for it in terms of the increased logistics requirements as of late, I believe, due to the increase, the long-term increase in online retail and the gearing up for a different way of doing business with regards to retail. So I think the industrial property sector has more going for it. The retail sector has some pressures. Consumers will have been reprioritizing a portion of their expenditure away from luxuries, away from non-essentials such as eating out and entertainment. So that side of the retail sector, luxuries, non-essentials and postponables such as hardware products to do work on houses, things that can be postponed during periods of financial pressure, I think get postponed as consumers reprioritize to a certain extent because they have a bigger interest bill on their debt now. And they also have bigger fuel bills and basic foodstuffs bills as well because of the surge in inflation there. So that's not great for retail shopping centres. I think that the bigger centres are at a relative disadvantage because they often depend more on these entertainment and eating out and non-essentials and postponables. The small convenience centres more focused on basic grocery shopping, probably less affected by consumer demand coming under pressure and being reprioritized. And then, of course, there's the office sector. I don't think we're done yet with the adjustment, the longer-term adjustment which has to take place due to not entirely everybody coming back to the office in as greater numbers as what they did before lockdown. We've learned to work from remotely quite successfully, and there's more of that happening than prior to lockdown now, and I think that's a permanent new normal. So I think in the office sector, it'll still be the underperformer of the three because it's got this structural change, this longer-term structural change. There's greater remote working numbers now, less office space needed in terms of many corporates. If I can finally add a fourth property sector in the commercial property sector into the mix, it's the hotel sector. We saw the numbers coming out for May last month of hotel income, still 19% down on the corresponding on May in 2019. So it's far from fully recovered to pre-COVID levels, and that's probably going to be a slow process to get back to pre-COVID levels, especially in real terms when you adjust for inflation. Because if there's one thing a lot of people can put on the back burn in tougher financial times, it is holidays, it is travel, it is staying in hotels. So I think that the hotel sector remains battling to fully recover to pre-lockdown levels, given this tough economic environment that we find ourselves in once again. Thank you very much.